Going on, everybody? This is Economic News Insights, and today we're going to talk about investment strategies for beginners. So, if you're someone who's new to investing, that's what we're going to talk about here. This is going to give you ideas about asset classes, it's going to talk about dollar cost averaging, as well as investment strategies and how to kind of set up your portfolio for how you're going to invest in assets. So, if you guys are new here, smash up the like, subscribe to the channel. Let's get into this. So, the very first thing we're going to talk about is what are the different types of asset classes. By the way, we're going to use the tools that are available for 2025. Right now, AI is a great tool to use. This is ChatGPT. So if we're using ChatGPT, it's because this is where you're going to get a lot of the information. And all I'm doing is guiding ChatGPT to get the information quickly. So this is what we're going to do here. Stocks. Stocks, everyone knows what stock market is. You've heard that term. It's shares of ownership in a company. Examples being Apple, Amazon. You also have ETFs like Vanguard. Uh, you have JP Morgan, NASDAQ, S&P, all of that. So those are high long-term potential growth, right? So you're going to have more of an investment strategy with the stock market. It's going to have some volatility, but that's one way to do investing. Then you have fixed bonds, loans to governments or companies with interest rates. So this is more of a safer play. You have U.S. Treasury bonds, corporate bonds, municipal bonds. We're not going to really focus too much on bonds in this channel, but we're going to talk about it there. You also have real estate. For those of you who buy real estate in 2018, you watched it go up in 2022 to record highs, and then you've kind of watched it come back down and you're waiting for an opportunity to buy. But that's another market. You have commodities, physical goods like gold, silver, oil, agricultural products, wheat, and you're going to have some commodities on this channel, but we're not going to talk too much about that. Then you have cash equivalents. You could also get into treasury bills, money market funds, savings accounts. Not going to talk too much about that, but that is one market. Then you have alternative investments, private equity, hedge funds, venture capital, art, collectibles. We could have some fun with that, like NFTs. Cryptocurrencies, which is something we will be talking about, digital assets. You have Bitcoin, Ethereum, Solana, potentially very high risk, high reward, but also lots of volatility. Not for everybody, but some people can really get into that because they like that high gain opportunity. So the next thing we're going to talk about is your investment strategy. So the ways that I approach investment is you have three different categories, okay? You have the investment. The investment is a safe play. So the other one is a speculation and gambling. Let me break it down. So investment is where you buy and hold strong companies like Apple, Amazon, Google, Nvidia, Nasdaq, S&P 500. These are things that are safe long term. Yeah, there's going to be a little bit of volatility when the market comes down like we just saw in March, but overall, or April I should say, overall those kind of stocks are going to be more safe plays. Like you invest long term in Microsoft, more than likely you're going to see the market go up, unless, of course, the U.S. economy just completely blows out. Then you could be toe up, but you're investing in strong stocks, right? And so that's more of an investment. It's a long term perspective. You take a 5 to 10 year approach. Some people take a 20 to 30-year retirement approach. That's more for people who are, stable minded, right? Warren Buffett always says, you buy when there's blood on the streets, right? Or it's not when you buy into the market, it's how long you're in the market. So it's not timing the market. Everyone says, "Oh, buy low, buy high," but if you just look at the U.S. stock market over time, it went up, right? If you just bought the S&P over years, it goes up. If you just bought the Nasdaq, it goes up. So if you take this approach to investing, that's more of a safe play. It's just going to continue to watch your money grow. Then you have speculation. These are more aggressive stocks that have an upside but higher risk. The stock is considered being hazardous and trading to a relatively low price because of its fundamentals, but does not appear strong to have a sustainable business plan. Yet the trader is optimistic that this will improve the future. So you're getting into something, I would say a speculative stock that I recently bought was Palantir, and it's been working out. Another example could be like, say, Bitcoin or Ethereum. Those were speculative stocks or speculative assets that I bought that could have gone to zero, but they held their ground. Sometimes I would say it's a little bit more higher risk, but higher reward than investing. So this is more of like an an aggressive investment strategy is speculating on something, speculating on gold, speculating on something. I mean, you could say that gold's a pretty safe investment, but if you speculate on some other precious metal long term, and then something else goes up, it could be a speculative mistake on your end. Sometimes speculation can end up getting you in the butt, but it's not. It's usually a safer play than gambling. Gambling is more like penny stocks, digital assets like altcoins. Now, why would someone invest in or gamble? Why would they take this opportunity to put their money into something that was high risk, high reward? Because they're really looking to hit it big. Like, for example, gambling would have been buying Bitcoin when it was like 10 cents, okay? And it would have paid off for you because now Bitcoin's trading at like $95,000. But does it always pay off? No. Like there's some altcoins. I remember one time I put in money into an altcoin. I put in $500 and it turned into $50,000 within 2 months. This kind of stuff can happen. They call that like a 50x or a 100x. Some people get a 1,000x return, but that's gambling. And gambling is like a lotto ticket, right? So yeah, you can win the lottery, but the odds are against you. So meme coins, we saw that. That's gambling. Now, as far as strategy goes, I want to talk about dollar cost averaging, and that's where we're going to go back to ChatGPT to really dial this in. And so, if we take a dollar cost average approach, this is one way to enter into the market, right? So, right here, you can see dollar cost averaging. Invest a fixed amount consistently, $100 every month. So, it reduces the risk and buying at market highs, right? So if you get into dollar cost averaging, an example would be you take 10% of your income and you just invest that into the stock market. Or let's just say you bought Bitcoin. Right now it's 95,000. If it goes down to 85,000, you're getting more Bitcoin. You have more purchasing power to buy more Bitcoin. With that $100, you're getting more percentage of that asset than you would if you're buying it, say, 110,000 or 95,000. So when it goes down, you're actually looking at it like it's a good thing because you believe long term Bitcoin has a use case as digital gold or a possible reserve currency status because the world is looking for an asset like this. So dollar cost averaging limits the amount of exposure that you have to craziness, right? So you have this mentality like when it goes up, it's like you're still buying, so you're happy because your overall portfolio is going up. But then when it goes down, you're like, great, I'm buying more of the same thing that I believe in long term at a cheaper price. So that's why a lot of people like dollar cost averaging. So this is one way to get into, say, Palantir, or you could get into Google or Microsoft, or maybe even a speculative asset you can do like that, right? And then so I would always say take the long term approach. If you invest in something, unless you're a trader, I'm not recommending newbies or beginners do trading. I'm saying you get in, you take a 5-year perspective with Bitcoin. If you look at Bitcoin on a 5-year chart, or you look at the NASDAQ on a 5-year chart, or the S&P on a 10-year chart, it goes up. Sure, there's volatility. It forms crocodile teeth, right? Like there's the chart, it goes like that, but it slowly goes up, okay? So if you're short on that, if you're short-term investing on it, every time it goes down in April, you would have been panic selling. You don't want to be in this position where you're panic selling. So you want to, dollar cost averaging can be really good if you take a long-term perspective with it, because you take that 10-year approach. You take Warren Buffett says, it's not timing the market, it's time in the market. So the longer you're in the market, the more strong you're going to be long-term because the U.S. economy just keeps going up. But you always have to take into consideration, nothing is 100%, is it? Nothing in life. Anything could happen, right? It's like you're pretty confident you're going to drive to work and get there, everything's good. You're pretty confident that, your bank account's going to go up, that you're going to show up to work, that you're going to have your job, all these different things, right? But nothing's set in stone and it's not all guaranteed. So you have that long-term perspective. You don't try to time the market. Time in market beats time in the market. That's a Warren Buffett statement, right? Then you have keep it simple. Sometimes when you're new, keeping it simple, getting into Vanguard, Fidelity, Schwab, just getting in with Berkshire, any of those, just keep it simple. Don't get too cute with it. Don't try and buy anything that's too much gambling or speculative. That's what newbies always do. They get in on some new thing and it's highly speculative. They FOMO, fear of missing out. They get into it and then they FUD. Fear, uncertainty, and doubt sets in and they sell, right? You don't want to end up in that situation. So we've talked about the difference between speculation and gambling, right? Now, here's how I would structure my beginner account if I wanted to get into it correctly, right? So what I'm going to do is I'm going to look at it like this. I have 10% is into gambling assets. This is typically what I recommend to someone who wants to take a little bit of an aggressive approach. I would say for most newbies, 100% strong investment assets. If you're a conservative person, you want to invest like a grandpa, you go out there, you buy the Vanguard S&P 500, you buy the JP Morgan, NASDAQ composite, you buy those and you just sit there and wait for the next 5 to 10 years. Or you buy gold and you just wait for it to appreciate in value. Or you buy Bitcoin and you do that. That's more of a speculative investment in this case, right? I would still put Bitcoin in a speculator's because you're going to have some more risk than you would have with Apple or Amazon or Facebook or any of those other stocks or gold even, but you're going to have a lot more opportunity for reward. So high risk, high reward. Gambling is going to be those penny stocks, 10%. Okay. So right now, I would say about 10% of what I own in my investment is gambling. But actually, if I were to look at it right now, just because the gambling stuff that I invested in kind of went down while my other strong investments have gone up, I would say it's more down to like 5% at this point. But that number can change at any given moment. If the market heats up, what ends up going up? The gambling assets. For example, in a bull run in crypto, you'll see all the low cap coins, they go up really quickly and then they sell off really quickly. So, you get a couple hits, big hits out of that, and you can be up. Take the investment strategy of venture capital, for example. In Silicon Valley, what they're looking to do is they're looking to take $100 million and they're going to seed fund 100 startups. And all they're looking for is one or two of those projects to really hit it big and become the next Amazon, Google, or Facebook, right? So that's all they need. And if one of those companies accelerates like that, they get way more than $100 million. They get billions of dollars. So to them, it's like, well, okay, I'll seed fund 100 companies, realizing that 90% are going to go to zero. If 10% work out, great. But all they need is one or two to end up being the next big thing. So you could see that could be considered kind of like gambling, but it's limiting the risk. So you could take that same approach to investing in small cap altcoins. If you know that the market is about to become bullish, you could buy 10 small cap altcoins, and then all you need is one or two of those to go up. Say you took $1,000 and you put $100 into each one of those. All you need is one or two of those coins to 10x or more, which really happens quite frequently. And then you make all your money back plus then some. But if you only go into like one or two gambling, your odds go down. It's kind of like buying 10 lotto tickets at the grocery store or at the convenience store. I'm not saying to do this. I'm just giving you an idea of how people approach the market and how it can work for them and how it has worked for them and why people would get into gambling. It's like the same reason why someone would go buy a lotto ticket. You're going to say to yourself, well, I don't think it's worth it. Whoever really wins at the casino, but that's why they call it gambling, right? Speculative investment, 20%, gambling, 10%, strong investment, 70%. Just be careful with this right here. If you're someone who wants to invest like a grandpa, take that more conservative approach, you look at something like the Vanguard, the JP Morgan, NASDAQ composite, ETFs, those are going to be more strong plays long term. And, again, just remember, this is not professional financial advice. This is giving you the tools, giving you the mindset to approach the market and say, okay, this is how I can make a successful investment strategy that's worked for others. But you have to take into consideration, nothing is guaranteed long term, right? Nothing. We don't know if, the US economy is going to be around strong for the next 10 years or 20 years. We're just saying, well, based on the last 100 years, if you bet on America, you were good, okay? but nothing lasts forever. We're also aware of that. But, if you're living in fear the whole time, you're just going to stay a wage earner for the rest of your life. And, at 80 years old, you're still going to be digging ditches in the backyard, or who knows, whatever it is that you do. Could be just like, as they say, slaving away. You don't want to be just a wage earner for the rest of your life. It's a tough life to live. I mean, that's what my dad does. He's invested in some silver. He's like gung ho on silver, but he's in his 60s, and he still has to work every day in construction, and he likes it. It keeps him busy. He'll probably live a long time because of it, because it's like an exercise every day. But that's the choice that he chose, and he's happy. But I'm just saying, some people, they retired already at 60 because they made investments. To each their own. We're not putting down anyone's decisions. We're just saying that if you want to make different decisions, and you don't want to be a wage earner for the rest of your life, this is how you can approach the market, okay? Or any asset class. Anyways, hope this helps. We'll make more videos. There's a lot to talk about here. We'll talk about derivatives, dividends, all that stuff. Thanks to everyone who crushes up the likes. We'll see you on the next one.